Welcome to the Deep Dive. We're jumping right into the source material you've shared with us today, pulling out the key insights you need.
Exactly. And our focus for this deep dive is Global Ship Lease, specifically their Q1 2025 earnings conference call. We're going to unpack what they talked about.
Right. Our mission here is simple. Help you quickly understand what GSL discussed, what's really driving their business at the moment, and what they're seeing ahead in their specific market segment.
Okay, so let's kick off with the financial snapshot. The headline numbers from Q1.
How do they do?
Well, they reported earnings and cash flow were both up compared to the first quarter of 2024, so building on strength.
And I gather they have quite a bit of revenue already locked in for the future.
They do. They highlighted nearly $1.9 billion in contracted revenues already on the books.
Wow, that's substantial.
Yeah, it gives them, pretty good visibility. The average remaining contract length is about 2.3 years.
And they were active in the first quarter itself, adding more contracts?
Oh, yeah, definitely. They added 19 new charters just in Q1.
19, yeah.
Mm-hmm. And those brought in approximately $352 million of additional contracted revenues.
So that really solidifies their position for the next couple of years, doesn't it?
Absolutely. They mentioned they now have 93% of their days covered for 2025.
93%.
And 75% for 2026 already locked in. They see this as providing, good insulation against uncertainty.
Makes sense.
Wow.
And did they talk about shareholder returns, dividends?
They did. They announced an increase to the annualized dividend. It's now $2.10 per share.
Okay, $2.10. So how does that compare?
That's actually a 40% increase compared to the same time last year.
40%? That's quite a jump. Signals some confidence, I suppose.
You'd think so. It definitely suggests they feel good about their financial footing and future cash flows.
Okay, so moving beyond just the Q1 numbers, what about their broader financial strategy, the balance sheet?
Yeah, a big theme was definitely building financial resilience and maximizing optionality, basically having flexibility.
Optionality, right? Being able to make moves when opportunities pop up or things change.
Exactly. And a huge part of that has been deleveraging. They've made, frankly, remarkable progress there.
How much progress are we talking?
Well, their key metric, net debt to EBITDA, is now under 1x.
Under 1.
Yeah. And just for context, back at the end of 2018, that same ratio was 8.4 times.
Wow, okay. That's a massive shift.
Huge. It puts them in a fundamentally stronger, more resilient position financially.
And cash on hand, what does that look like?
They reported $428 million in total cash. Now, about $95 million of that is restricted.
Okay.
And that restricted portion includes about $73 million of advanced charter hire money paid upfront by customers.
Got it. So that leaves a pretty healthy chunk of unrestricted cash then.
It does. And that's their, dry powder, ready cash for potential investments, covering operational needs, meeting covenants. They want to be ready to act.
And what about the cost of their debt? That's always crucial for shipping companies.
Right. They've done well there, too. They've managed to get their blended cost of debt down to 3.99%.
Under 4%. That's pretty low, especially given where interest rates have gone generally.
Exactly. It shows some successful refinancing efforts over the past few years.
So how does that low debt cost feed into their operating economics, their break-even levels?
This was an interesting point they made. You see, like everyone, they're facing rising operating expenses, crew costs, maintenance, etc.
Inflation hits everyone.
Right. But despite that, their overall vessel break-even rates have actually stayed flat. Just over $9,300 per vessel per day.
How do they manage that if costs are rising?
It's almost entirely down to the reduction in their interest expenses because they've lowered that debt cost so much.
So the savings on interest are basically offsetting the increases in operating costs.
Precisely. And the key thing is that $9,300 break-even is significantly lower than the charter rates they can get in the current market.
Right. So that difference, that spread, is where the strong cash flow comes from.
That's the engine right now.
Makes sense. They also mentioned selling some older ships. Why sell assets if the charter market is strong?
Good question. Yeah, they've sold some older vessels, ones around, say, 25 years old or maybe a bit more.
Okay.
They described the sale prices they got as cyclically attractive. Basically, really good prices right now.
Better than chartering them out.
Apparently, yes. For those specific ships, they felt the sale price offered more value than locking them into maybe shorter-term charters. It's about being opportunistic, turning older iron into cash.
So building up that dry powder again.
Exactly. More cash for future investments, maybe fleet renewal down the line when they see the right opportunity.
And they also did some refinancing recently, you mentioned.
Yes, an $85 million deal. The main impact was pushing out their average debt maturity to 5.1 years.
Extending the runway.
Right. And they did it while keeping that overall low-weighted cost of debt.
Yeah.
So locking in favorable terms for longer.
Okay, so the picture is stronger balance sheet, less debt, lots of cash, low borrowing costs, and strategically trimming the older fleet. It sounds like they're positioning themselves carefully for what they see coming.
Which brings us neatly to how they view the market dynamics right now. They didn't shy away from mentioning, unprecedented levels of macro uncertainty and geopolitical volatility. It's a complex world out there.
No kidding. So in that choppy environment, how's the specific market for their types of ships doing?
This is key. They described the market for the mid-sized and smaller container ships, their bread and butter, as exceptionally tight.
Exceptionally tight, meaning?
Meaning essentially zero idle capacity. Basically, every ship that can sail is sailing and earning money. This is happening even while you might hear about headline freight rates for the really huge ships coming down a bit.
So the underlying demand for these specific workhorse vessels is still very strong.
That's the message they conveyed. They really emphasized their focus on ships between roughly 2,000 and 10,000 TEU.
TEU being the standard container size.
Right. Correct. 20-foot equivalent unit.
And why is that size range so important for them?
They see this segment as the backbone of global trade. The main reason is operational flexibility.
How so?
Well, unlike the giant ships that are often stuck on the main east-west routes, these smaller and mid-sized vessels can go almost anywhere. They can serve smaller ports, more diverse trade lanes. They aren't dependent on just one specific route or country.
And that flexibility must be really valuable with all the disruptions we've seen, like obviously the Red Sea situation.
Absolutely critical. They spent some time on the Red Sea impact. Before the Houthi attacks started, something like 20% of all global containerized volume went through there.
20%, wow.
And that represented about 34% of the actual fleet capacity transiting that route. So when ships have to reroute all the way around the Cape of Good Hope in Africa,
it adds a lot of time to the journey.
A huge amount, which means you need more ships to move the same amount of cargo. It effectively tightens vessel supply globally.
Okay, but you hear talk about potential ceasefires or things calming down. Are liner companies rushing back to the Red Sea? GSL didn't seem to think so.
No, they highlighted that the threshold for a widespread return is actually very high.
Why is that? Safety first, obviously, but what else?
Safety is paramount, absolutely. They need real conviction that it's consistently safe long-term, not just for a week or two. But beyond that, think about the logistics.
Okay.
Liner companies have spent months completely reorganizing their global networks, schedules, port calls, everything around the longer Cape route. It's been a massive undertaking.
Right, a huge reshuffle.
Exactly. So just switching back isn't flicking a switch. It means disrupting everything again. It involves enormous complexity, cost, and planning across their entire system. They're not going to do that lightly.
Got it. So it's not just about the immediate risk level, it's the whole operational network stability.
Precisely. They need real confidence in sustained stability before making that kind of disruptive shift back.
Okay, another big factor muddying the waters is trade tensions, particularly U.S.-China. How did they discuss that?
Yeah, definitely part of the complex backdrop. They noted U.S. imports are a big slice of global trade, maybe 13%, and China's historically been a huge part of that, almost 40%.
Mm-hmm.
Tariffs, they mentioned, did spike up significantly back in April, caused some jitters, but seem to have de-escalated a bit recently while talks continue. It's, very fluid.
And what about those proposed U.S. port fees on Chinese ships? The USR thing.
Right, the USR. The idea is fees on ships that are either Chinese built or Chinese operated. And that could be a really big deal.
Why is that?
Because something like 28% of the current existing global fleet was built in China. And get this, 71% of the ships currently on order are being built there.
71%. Wow. Okay, so that affects almost everyone.
Potentially, yes. It touches a huge portion of the industry.
But are those fees definite? Are they happening?
No, not yet. They stress it's not final. It's gone through reviews, apparently been sort of watered down a bit from initial ideas, and another review was scheduled. Crucially, the current expectation seems to be that ships of 4,000 TEU or smaller won't be hit by it.
Okay, 4,000 TEU. How does that relate to GSL's fleet specifically?
Well, they pointed out they own 10 ships built in China, but only 4 of those are actually larger than 4,000 TEU.
Only 4.
And importantly, none of those 4 are currently trading on routes between China and the US.
So again, that operational flexibility comes into play. They can deploy them elsewhere.
Exactly. That's a core part of their strategy and positioning. Their ships aren't locked into those main trans-Pacific lanes where these specific tariffs or fees would bite hardest. They operate globally, and most global trade doesn't actually happen on just those main lanes.
They used a past example to illustrate this, didn't they? From 2019.
Yeah, it was quite interesting. They looked back at the last big round of US-China tariffs in 2019. What happened then was demand for the really large container ships on that specific China-US route went down.
Okay, that makes sense.
But crucially, overall, US consumer demand didn't just disappear. Instead, companies started sourcing more from other places like Southeast Asia, Vietnam, Thailand, etc.
Which makes the supply chains more complicated, right? More spread out.
Exactly. More fragmented, picking up goods from multiple countries, different ports. And that kind of fragmented, complex network needs more flexible shipping capacity. It favors the mid-size and smaller ships that can call at more ports and offer more adaptable services.
And they think something similar might be happening now.
They suggested there's anecdotal evidence pointing that way. Volumes potentially being displaced from direct China-US routes might be getting picked up elsewhere in Asia, again benefiting the sort of flexible mid-sized ships they operate.
So the takeaway is that these trade tensions have complex ripple effects. It's not just about the main route, and uncertainty actually tends to favor flexibility.
That's a good summary of their point. It's about those second and third order effects.
Okay, let's switch gears to the supply side. New ships coming online versus old ships getting scrapped. What's the picture there?
Right now, very little action on either front, really. Idle capacity is negligible, basically. No ships are sitting around doing nothing.
Because the market's strong enough for them to earn money.
Exactly. And that also means scrapping activity is minimal. Even older ships are kept trading because they're profitable.
So not many ships heading to the scrapyard beaches right now.
Not at the moment. But they did make the point that if demand were to drop off significantly, scrapping could ramp up very quickly.
Like a safety valve.
Yeah, they use that exact term. It could take capacity out of the market relatively fast if needed.
Okay, but what about the new ships? The order book. We hear a lot about how big the overall order book is for container ships.
It is large overall, but they stressed you have to look at the details. Where is that new capacity actually coming?
Right. Not all ships are the same size.
Exactly. The vast majority of the order book, over 54% of it, is for the really big ships, vessels over 10,000 TEU. In contrast, for the segments they focus on under 10,000 TEU, the order book is much, much smaller, only about 11-12% of the existing fleet size in those segments.
11 to 12% versus over 50. That's a huge difference.
Massive difference. And that 11-12% is spread out over the next, say, 3 years of deliveries.
Yeah.
So significantly less new supply pressure in their specific markets.
That's a really important nuance.
It is. And you have to combine that with the age of the existing ships in their segments.
How old are they?
The median age for ships under 10,000 TEU is around 17 years old.
17 years median age. That's getting up there for these kinds of assets.
It is relatively old, and they presented an interesting calculation based on this.
Which was?
They suggested that if you assume ships aged 25 years or older get scrapped in the coming years, and you net that against the deliveries from that small order book, then the actual fleet capacity in their peer group, the sub-10K TEU ships, could potentially contract by maybe 6% to 12% through 2028.
Contract. Not grow, but shrink.
Potentially, yes, based on that scrapping assumption and the current order book. So fleet growth in their niche is absolutely not a given.
Interesting. So significant growth would likely only happen if the market stays super profitable, making owners keep very old ships running longer and maybe ordering more.
That seems to be the implication. The underlying potential for supply to actually tighten in their segment if conditions change even moderately looks quite real based on the fleet age and limited order book.
Okay, so let's try and pull that market and supply picture together. They're describing a currently very tight market for their specific ship sizes, driven by factors like Red Sea rerouting and maybe trade fragmentation. Combined with the supply side, where new deliveries are relatively limited for their segment, and the existing fleet is quite old, suggesting scrapping could really bite if demand softens.
That captures the essence of the landscape they laid out, yes.
Okay then. Based purely on this detailed analysis from the earnings call, the strong balance sheet they've built, the high level of locked-in revenue giving stability, the rising dividend, plus these specific market dynamics benefiting their niche of flexible mid-sized ships facing limited new supply. Let's brainstorm a potential trade idea.
Right, just spitballing based only on this info. You could perhaps think about a long position in Global Ship Lease.
And the rationale would be?
Well, the argument, again, based strictly on this call, might be that it acts as a sort of defensive play. You potentially get an attractive yield from that increased dividend.
Okay, the income aspect.
Yeah, and maybe there's some hidden upside potential from these segment-specific supply and demand factors, the tight market, the limited order book for their ships, that maybe the broader market is overlooking because it's focused on, general macro gloom or the volatility on the main east-west trades.
So the idea would be trying to capture the good parts, like that big gap between their low break-even costs and current charter rates, while feeling somewhat protected on the downside by their strong finances and all those contracts they already have signed.
That's the shape of the thought, yeah. An idea that emerges directly from unpacking the specific points they made in the call.
And we have to hammer this home. This is absolutely, positively not financial advice. Seriously.
Couldn't agree more. This is purely a hypothetical scenario, an intellectual exercise based only on the source material we just discussed. Nothing more.
Right. Any investment decision involves risk. You could lose money. Always do your own detailed research, consider your own situation, and talk to a qualified financial advisor before doing anything.
Absolutely essential.
Okay.
Right.
So wrapping up this deep dive into the GSL Q1 2025 call, the key takeaways, I think, paint a picture of a company that's built a pretty solid financial foundation.
And one that seems strategically well-positioned within a specific and currently quite robust segment of the container shipping market.
A segment that, based on their commentary, appears fairly resilient right now and might even be benefiting from some of the current market complexities, like the Red Sea diversions and shifting trade patterns.
Seems to be the case, based on their analysis.
And, of course, the usual reminder, anything discussed on the call about the future involves forward-looking statements. These are inherently uncertain, subject to risks, assumptions. Things might not pan out as expected.
Definitely. The global shipping world can change on a dime, as we've seen many times.
So let's end with a final thought for you, the listener, to chew on, something building on what we heard today.
Okay.
How might this potential long-term shift towards more complex, maybe more fragmented global supply chains driven by geopolitics, tariffs, companies wanting more resilience after COVID disruptions, how might that continue to specifically favor the operational flexibility and the tighter supply dynamics we see in the market for these mid-size and smaller container ships? Could it reshape the industry in ways that go beyond just the obvious first-order impacts of big global events?
That's a really interesting question to ponder as global trade keeps evolving. Something to keep an eye on.
Indeed. Well, thanks for joining us for this deep dive into the Global Ship Lease Q1 call. We hope this breakdown helps you stay informed.
Until next time.